So let me start by saying that by now I have been in the business of being in the central banking business for more than 20 years. And in that capacity over the years, I've had the great privilege of giving speeches all over the world during one period working for the IMF. So I've been here before. And presently, in my capacity as chairman of the Basel Committee, I also give all sorts of speeches on monetary issues. But what is absolutely remarkable, and I'm delighted to be here, is that this is the first time ever that I'm giving a speech on down-to-earth central bank payment systems plumbing. And that's remarkable because normally you never talk about these things, you take them for granted. And I'm grateful for having been given the opportunity to talk about these issues here in Buenos Aires today. It's absolutely remarkable because it's an unusual topic, and given that I started out during the Bronze Age doing pure monetary theory a long time ago, it's nice to talk about this. And Professor Álvarez also gave you a nice introduction to this topic. I'm going to talk about exactly the same thing, but I will do it from a more kind of a national perspective, describing what has happened in my country. Whether that's right, wrong, good, bad, that's for others to decide. I'm going to give you the story about where we ended up and how come we ended up where we are today. So let me move back in time. Back in 1661, there was a privately owned bank called Stockholm Banco. The guy running the bank started issuing depository receipts, notes. The problem was that he issued many more notes than what he had received metal. So there was a run on the bank, which is quite common and well known. And the government and the parliament of that day decided that banking was simply too dangerous for the private sector. And that led to the establishment of Sveriges Riksbank. And we've been around since 1668. So we've been in this business longer than most. But the parliament of that day also decided that issuance of notes was just too dangerous. So there was a ban on it. So they said, this is dangerous, let's get rid of this whole thing completely. But eventually, the Riksbank was allowed to start issuing notes again in the early 1700s, and we have been doing that since. So then one would think that we would be really, really in favor of cash. But I'm going to give you the story why that is not so presently, and how come we have ended up being among the countries with the lowest use of cash in the world. So let me give you first a little bit of background. If you look at the blue graph, that's cash relative to GDP, and on the left-hand side there you can see that now presently we're sort of at 1.5%, something like that, of GDP, which is probably one of the lowest numbers in the world. But you can find many graphs that look sort of similar. Basically what the blue graph says that you don't need cash in terms of looking at the whole economy. Cash is in that sense a kind of a sideshow, and more so over time. Now, what is unique, though, is if you look at the red graph, because that's the nominal outstanding amount of notes and coins in the country. And as you can see here, over the past 5 years, there's been a drop in the use of notes and coins by roughly 40%. And the red dot there, which is right close to 60 billion, is the last reading that we have. And as you can see when you look at this graph, we are heading towards zero at a fairly rapid pace. Now, that doesn't mean that we're going to end up zero for sure, because if you think about how monetary instruments have evolved over time, and now I'm talking about hundreds of years, all old instruments in a legal sense always exist. It's just that you stop using them. So that's the background. And now if you compare a few economies and what it looks like, and this is a bit tricky to look at, but anyway, on the On the x-axis, you have percent cash in circulation relative to GDP. And on the y-axis, you have card payments per person and year. And basically, you have three groups of countries. The red dots are high-income countries where they do not use a lot of cash. The top one there, the red filled one, square, that's Norway. And the one with the green circle, that is Sweden. And then you have Denmark and a few others there as well. Then you have another group of high-income countries, the blue dots, where they still use a lot of cash, and then you have a number of emerging markets where cash is really used quite a lot. But as you can see here, basically we're talking about the Nordic countries, and in my corner of the world, cash is on its way to become kind of irrelevant. That's essentially what these dots show you, and this is a process that is not driven by the public sector in the sense that there is no one who has decided get rid of cash. Sometimes it's expressed that way, but this is an evolution that is pretty much propelled by technological change. That's what I would say. But how did we end up up there? So let me give you a little bit of history and how come. Going about 100 years back in time, the government of that day decided to create a post gyro so that you could send money crisscrossing the country from one end of the country to the other. Now, this was a uniform, highly standardized system, and given that there were post offices all over the country, it made it quite convenient actually to transfer money. And actually, that created an environment where there was no need to put cash in envelopes, sending it from one end of the country to the other. And at the same time, there was particularly no need to send checks back and forth. So already back then, it was kind of became irrelevant to use tons and tons of checks, which was, from a transactions purpose, actually quite important. This was kind of a bank within the bank owned by the post office. And I still think that the Riksbank has the account number 2. And whether it was the king or somebody else, number 1, I don't know, or such a number exists. Now, this, of course, bothered the banks, because this essentially meant that it was very hard for the banks to compete in this business when it comes to small transactions throughout the country. So back in 1950, the privately owned banks started a standardized paper form for bank credit transfer, the bank gyro system. And back in 1959, they created Bankgirocentralen, which is an automatic clearing house for these types of transactions. But the basic thing here is the same, that this actually reduces the need for holding cash, and it reduces the need for sending checks back and forth and money back and forth in the country. Now, in order to create something like the post-gyro or Bankgirocentralen, you have to accept standardization. Because without that, these things never fly. And you have to accept the basic idea that there are huge returns to scale. And you have to accept interconnectedness among all the banks. Because if you don't accept that, then you end up in a situation which is actually quite similar to owning a fax, and you happen to be the only fax owner in the world. That doesn't make any sense. So in the end, you have to accept these scale economies, and without that, it doesn't really work. You also have to trust those who participate in the system. Because if there's no trust, the thing won't fly, and then the whole thing just falls apart. And all these systems, and that holds to this day, are actually a combination of technology and the legal framework. And without a legal framework that you don't trust, forget about the whole thing, because then technology as such won't help you. So it's actually the legal framework and the rule of law in combination with using new technologies that do the trick in terms of getting as much efficiency out of the system as possible. And as I said, there are huge returns to scale, and that kind of cuts both ways, because then you can say, well, maybe there is not enough competition. But let me give you an example of what that has meant in my environment. What is it that the cooperation among banks, other than the bank gyro today? First of all, when it comes to card payments, we have only one network and only global brands. And that means that it's, of course, very, very easy to use those networks. When it comes to ATMs, we have one company, Banco, which owns and operates all the bank's ATMs. There are a few other ones, but basically they are the same, so that you can go to any ATM and get your cash if that's what you want. You have a common system called Bank ID, which is a company that provides electronic identification services used by banks, businesses, and the authorities, not least the tax authorities. What that means is that you can use your own ID, your bank ID, when you do banking business, but you can also use it when you electronically log on to the tax authorities and make your tax payments or see what's due and all those things. And there is a mobile real-time payment system, which is the same application for all the banks that have joined the system. It's called Swish, and it's a uniform infrastructure, and I'll get back to that in a few minutes. And then there is a company that acts as a wholesale actor between the banks and the central bank, dealing with cash distribution. So that's kind of the private sector background when it comes to dealing with these things, and it's, as I said, based on the rule of law, high degree of standardization, and trust among the participants. And without those features, these things just don't work. So now let me get a bit into where the central banking part of this comes from. Prior to the 1980s, the central bank had pretty much a branch in each province, and that meant that we had around 20-some branch offices all over the country, and we supplied many different cash management services, and the important thing is without full cost recovery. I think if you would go back to in the 1980s, it was probably about 1,000 staff members essentially moving cash back and forth. And here you need to know that technological change has been enormous, because people actually used to count the notes by hand until the early 1970s. And it took a lot of people to do that when you had to do it all day by hand. And now you can sort all these things in pretty much, I think that you can do the whole country in terms of sorting notes in 2 or 3 machines. That's the increase in productivity when it comes to actually do these things. In the 80s, given that this organization was seriously overstaffed, we tried to find things for these people to do, so they moved into various kind of commercial activities in addition to all the other things that they were doing. But there were also problems with this. First of all, the price mechanism was completely distorted. Basically, the price mechanism did kind of not exist, because the banks did not bear the full cost of transporting cash, implying a lack of transparency of costs. And basically, it was an implicit subsidy of the whole system, given that basically all these costs were picked up by the central bank. This created a lot of unnecessary transportation and movement of cash in the systems, because the banks had a very strong incentive to bring all the cash to the central bank, because then when they deposited the money with the central bank, they could get interest on their deposit. So they had a trade-off between actually transporting cash, receiving interest on the deposits, And this sort of kept the money moving in and out constantly out of the central bank. And over the time, we sort of realized that this is not a good thing, and we performed services that market participants could do more efficiently. And in some cases, as I said, we also tried to compete. And this meant that around 1980s, we embarked on three decades of reforming cash distribution. I mean, where we are today would have been absolutely unthinkable 30 years ago. So this has been a very, very gradual process over time. So let me go through the different steps here. Now, in the late 80s and the early 90s, we started downsizing. So the system shrank on our side down to 11 branches. And that meant that, of course, that a larger share of the transportation cost was shifted from us to the private sector. And that made it more costly to deposit cash at the bank overnight. Now, in the 90s, we said in the late 90s, we said to ourselves that we want to make the system more transparent so that you can actually better understand what it costs moving the money around. And the aim was very clear, to make the market bear the costs and also have the influence to decide for themselves how they actually manage cash handling. So that was an objective of ours in itself. And all cash handling was eventually organized in a company owned by the bank. And we actually had the basic idea that we would sell this to market participants, but this company wasn't all that efficiently run, so it cost us actually about 500 million to get rid of this thing. So there was some very, very costly learning by doing as part of this process. So that wasn't a happy experience, but more and more was pushed to the private sector. Now, the second part of it then was back in 2003 and 2004, there was another study made on the future of cash distribution. And the basic idea was to figure out a way of doing this in such a way that banks don't come to the bank with their cash unnecessarily. That was the basic idea. Circulation of cash, which by the way, kind of reminds you how you deal with empty bottles, because that's also circulating things. So from a logistical perspective, it's kind of one and the same. You just move this stuff around, and you want to do it in as efficient a way as possible. Now, the idea that we came up with, right or wrong, was the following: that we said, let's pay banks interest compensation for cash that they hold in their own vaults. Because by doing so, it's up to the banking sector itself to decide if they want to have 5 vaults, that's fine. If they want to have 500, that's fine as well. But we put in very, very strict rules dealing with this. So what you have in a vault has to be defined as cash not in circulation. But the cash is owned by the banks. And this is very, very important, because then they have to pay for the vault, they have to pay for insurance, they have to decide how many vaults to have and how to run the whole thing. So they end up with a cost minimization problem, which just did not exist there before when we subsidized the whole system. And once this was up and running, and now it has worked actually for a large number of years, we started downsizing our vaults. And by 2014, we only have 1 cash depot left in the country, which is completely computerized. And it only takes 8 people to run it. So basically, we have gone from 800 to 8 people when it comes to dealing with all of this. In addition, over the years, we have sold our note printing and paper mill company because it's very, very hard to compete in that market. And there is a global market for notes and coins. And you can buy this stuff, and there is excess supply. So you can, if you know what you're buying, normally you can get a pretty good price. And that was a success as well. Now, the general idea when it comes to all of this was to make sure that costs would be transparent, and that we would have one cash center, and that we would have, as I said, a very, very limited role when it comes to dealing with this. And that's essentially providing new notes and coins, and then receiving all the notes for destruction. And that's about it. Now, in addition to this, there's been a lot of innovation going on in the market. So we have Swish, which is a real-time person-to-person mobile 24/7 payment system, and which is growing very, very rapidly. And this, of course, means that the younger generation, they don't care about cash at all, because they just send money from one cell phone to another. This system is facilitated by us, because those who run the system have an overnight credit with us, so that when our own RTGS system is closed overnight, there is enough money in the system in the morning in order to clear the whole thing in central bank money when you open up this. Other systems are iSettle, which is basically a tiny little thing that you use to put your credit card in, so that, let's say, small businesses can use this instead of using cash. And Secure is another system that you can use for making payments in small businesses. And we also have, and this is important, as I said earlier, we have a standardized bank ID, which is normally what you use when you make payments using the internet. But we also have a mobile bank ID. And that also needs to have the same level of security and standardization, because that is essentially what makes it possible for an individual using your cell phone hooking up to the system. And that's very, very important, because without that, it just wouldn't work, because then you would not know who's at the other end when you transfer the money. So, cash then, presently, first of all, less cash is the outcome of a market-driven process. It's not that somebody on the public sector has decided, let's get rid of the money. This is presently a quite swift process, because we estimated that the share of cash payments at the point of sale in 2010 was about 39%. Today, it's probably below 20%, because this process is very, very, very fast. Also, what really matters here is what I say here, that on the one hand, cash is legal tender, but you don't have to take cash if you run a store. It's enough to have a sign in the window saying that we don't use cash. And I would say that roughly maybe half of all the bank branch offices today don't accept cash at all. And that means that you cannot get cash when you go to a branch office, nor can you deposit cash when you go to a branch office. And this is a process which is very, very fast right now. Then, is there a tipping point? Well, accepting cash payments is associated with a cost, and if fewer and fewer people are using cash, well then, maybe eventually you get to a point where you say, on the one hand, cash does exist, but I don't want to use cash anymore in my business, and then of course all of it becomes electronic. And it's not completely unlikely that eventually could get to a point when some stores stop accepting cash, and when it's actually not very attractive to use cash at all. Now, and this brings me then full circle to what I started out saying. We've been in this business for a long time. And given that Sweden in the 1600s was a copper-producing country, the largest producer of copper probably in Europe, most of the gold and silver came from down here, but we were not down here. So this coin that you can see in an iPhone here weighs about 20 kilos. It's very hard to put in your wallet. That creates a very strong incentive to create cash on top of copper coins, because it's so cumbersome. Now we have been successful in tweaking the system so that we have cobbled everything into the cell phones. And now, of course, the challenge for us is to think about what to do next on the side of, or on the public sector side. Because what this essentially means is that our seniorage from issuing notes and coins is disappearing. And eventually, given that the central bank was given the monopoly to issue notes and coins about 100 years ago, our next challenge is really to think hard about whether we should or shouldn't start issuing our own electronic currency going forward. Thank you.
Thank you, Stefan.
Vamos a disponer entonces de unos minutos.
Now we are going to start the Q&A session. Dr. Llach will chair the Q&A session. Thank you so much to both guest speakers. So we are going to take just a few questions, please, and then you can answer these questions in full. Thank you. Andy, yes.
Fascinating presentations. I'm trying to put them together, which is not so easy. I mean, it's a really fascinating account that from Stefan that focused more on the transactions side. My question for Stefan would be, I mean, there are other countries that have also had many advances, but they haven't eliminated cash in the same way that Sweden has. So I'm interested in what you think the difference would be between Sweden and other countries that have had similar technological advances but haven't reduced cash to the same extent. And for Fernando, I mean, it's fascinating. It really is. It's incredible. I'm wondering whether you've looked at, we live in a zero inflation world, so obviously holding cash is less costly. I also wonder whether, in some countries it's related to informality and it's related to crime. There's an office in Washington called something Financial Integrity Associate. They track illicit flows, and I'm wondering if there's a relation between the use of cash and their data on illicit flows, for example. So I'm curious as to your explanations.
Otras preguntas y después contestan.
José de Gregorio, please, and then Remian Radel. I have a question for Stefan. The problem in many countries, developing countries in Latin America, to introduce more digital currency or less cash has to do with the cost associated with bank networks, payment networks, which is much more costly, less costly as it happens in your country, Sweden, less transactional costs. What happens and what is your opinion about that? And then Fernando, you have done and conducted wonderful research into the fact that we are going towards a cashless economy on the one hand, but this goes against a little bit about the view of Stefan, because in Sweden cash is disappearing, and Fernando says even though we're going towards a cashless economy, there is much more cash in many parts of the world. How can you really match these two ideas? What about store value? Thank you. Demian and Daniel Marx. This is a question for Stefan. I noticed that the market structure in Sweden has to do with one single company, Banco, Swish, and some other technological examples that you have shared with us. So, how are you managing the trade-off between efficiency and monopoly power? Is there government regulation? What's going on? How to manage to reduce costs? Fernando, this is a question for you. Why have you associated the store value function holding money vis-a-vis having electronic accounts which pay zero interest? And two more questions only. One, a gentleman here and then Andy Niemeyer. I have a question for Stefan. Our banks, our central banks, and our monetary policy is strongly anchored to cash. Our policies regarding, for example, legal requirements, bank requirements, minimum requirements, make the central bank become a manager or at least promoter of the use of cash. How can you manage this? Which is your opinion about this? Secondly, if we have a policy trying to eliminate cash from our economies on the one hand, and we see our countries where we have to do additional work in order to build trust, because if we want to eliminate cash but there is no trust, we have seen in our countries that this trust, this has been reduced among the public at large. How can we build trust in order to be able to go towards a cashless economy? And how can we have the legal certainty in place to favor a cashless economy? So again, trust is another very important element along which we have to work along in our countries. It is not only a matter of advanced technologies, it is also a matter of building enhanced trust. So we have to adapt ourselves in our countries in order to be able to reach this goal of a cashless economy, because there's no trust. And Andy, the last one. Stefan, I'd like to ask you if banks in Sweden are paying negative nominal bank rates, and how can you see these nominal bank rates all over the world vis-à-vis the use of cash? What do banks pay for their cash account balances? Well, you have a lot of time to deal. I'd like to ask you, Stefan, do you have any special thought about this last question? Should central banks issue electronic money or not? Well, if there's time, that's my question. So first, you answer this question. Thank you. As a matter of fact, you know that cash is used in these bank flows. But in the times of using the euro at large, we were studying the demand for money in order to analyze if there were criminal activities. I do remember that we were calculating for each region the crime rate times the type of crime times the amount of money that was being managed. And then we got the opportunity cost, that is to say, the amount of money used by each individual. So, as we were able to control this data according to cash expenditure, we could determine the opportunity cost. We know the overall scenario in Argentina. And then the second question about matching these two different views. There is much cash all over the world, and I mentioned that the overall scenario is very heterogeneous, but many countries are using more cash, and much more cash, such as Germany and Austria, even though the overall trend is towards a cashless economy on a worldwide basis, as it happens with Sweden and the USA, and the story of American Express, and the use of, as it happened in Sweden, the post-gyro tools. So, if the use of cash is disappearing, cash is also disappearing as a store value tool. When I mentioned that all these interactions were very important, because if cash disappears as a store of value, it will also disappear as a transactional tool. But Sweden is on one extreme, and the rest of the world is on the other extreme. So try to keep an eye on this different situation. So, again, I do repeat it once again, Sweden is an extreme case concerning technological innovation. You are very advanced in this regard. On the other hand, we can fix the nominal rate, okay? But concerning money, cash, you can't pay an individual a negative bank rate, okay? And this is the difference. I mean, in an e-account, you can pay a negative bank account, but cash has a zero nominal rate. And this is the underlying difference. And this is the reason why cash, of course, presupposes the existence of an overbound. I'm sorry, he's not using the mic. Well, no, it can be negative at the very beginning, okay? Stefan?
For many good and interesting questions. So let me see what I can do. Why Sweden? I would say no, it's not just Sweden. You can look at Finland, Denmark, Norway, Iceland. Exactly the same thing. I have spent the last 2 summers in Finland because that's where I grew up, without using any euros at all, cash, because you don't have to. Because you can use card payments everywhere, and that's not an issue. But how do you end up in that corner? Well, yes, I started out saying you have to be cooperative. And you need to have a high degree of technological penetration, in the sense that the use of internet has to be pretty much universal. And you need cell phone networks that are available everywhere in the country. And this tends to become an issue, let's say, for some of the major ski resorts, because in the summer, cell phone coverage is enormous because there's no one there. But in the winter, it's hard because then you have thousands and thousands of people using the cell phones in the same spot, and that's kind of an issue when it comes to the rural parts of the country. And you also have to live in an environment where the general public is basically used to adapting to technological change. And let me give you one example, which is very little known. I think that the use of landline telephones per capita was the highest in the world in Helsinki and Stockholm 120 years ago. So it has happened before when it comes to adapting to technological change. Now, monopoly power. Very good and very relevant question. These networks need to be open, fairly open, so that if you open up a new banking business, it's not acceptable to actually for the other guys to keep you out. This, of course, leads to perennial conversations between the old banks and the newer banks. But essentially, somebody on the public sector side has to settle the issue of openness. Because if that is not the case, then you end up with 2 large monopoly profits coming out of this, and that requires interoperability. And also, we have a very liberal system when it comes to starting new banks, because you can start a banking business today completely without a branch office. And we have a few banks that only exist on the internet and so forth. So you need to accept ease of entry, which of course doesn't really change when it comes to the largest banks, because the largest banks have in one form or the other been around for 100 to 150 years. So it's not so easy to grow in that environment. And I also think that what matters is people's views on privacy, because the taxman knows what you are doing anyway. So you just cannot escape. And that's a completely different topic, which has nothing to do with what we're talking about today. But if you set up a system where you cannot pay cash to the state, it has to be electronic payment, well, then you're part of the system and they understand what you're doing. And if the employers do the reporting to the tax authorities on how much money you make, basically it's a completely electronic system where you just kind of just have to tick a box on your cell phone, and that's how you settle your tax receipts. So you don't get this discrepancy between how much money you make, what the government is keeping track of, and using these types of systems, because that is known already. Now, emotionally, people tend to be in favor of cash because we're used to that. But what really matters if you're on the public sector side is to use policies such that you have a safe and efficient payment system. It's that broad statement that really matters. Whether that means that it's paper or electronic or something else, that doesn't really matter. It's this overarching idea that the payment system is supposed to be safe and efficient that really matters. The rest of it you can kind of allow to happen more or less by itself, given that you have this particular constraint. Now, there was a good question about trust, hard to answer. A simple answer, which is not only about payment systems, but it's a very general statement, is that in order to create trust, you have to do the same thing for a long period of time in an orderly way. And that's a very, very general statement, and if you don't want to stick to that rule, you have a problem. And this has been tried over and over again globally in many different shapes and forms, but those are kind of the basic rules that you have to stick to. The question about a negative policy rate. First of all, when it comes to the negative, we're presently at minus 0.5, but that negative rate is only paid by the banks when they deposit money with us, the central bank. Deposit rates for households is at 0. So in that sense, it doesn't really affect them. Now, at this level of a negative rate, technological change completely dominates. The convenience factor of not having to use cash dominates totally over whatever tiny fee that you maybe would end up paying if also deposits were to go negative. But there is, of course, a negative number which is large enough in absolute terms such that people would start hoarding cash again, but we're by far not at that level as of yet. Another way of thinking about a negative rate being a bit technical is to say that it's equivalent to a positive rate when the central bank uses a reserve ratio without remuneration. And this is rarely explained and described in this way, but that's kind of how it works. Then finally, the issue of central bank electronic money. Well, I think that the distinction here is really between wholesale and retail. Because given that we operate, which is the case all over the world nowadays, we operate a real-time gross settlement system for payments between the banks. Now, why is it that the central bank ended up in the middle? Because the banks don't always trust each other. So we provide them with wholesale transactions of electronic money. And that's kind of why we exist. And in our system, the turnover is between, let's say, 500 to 600, 700 billion a day. So we pretty much do a little bit more than GDP in a week. So we are talking about very, very large transactions in Swedish kronor when it comes to this. The real issue before us, and this is not new at all, but it has almost never been phrased the way I'm going to phrase it right now. Think about it in the following way when I'm talking retail. Banks, and this holds for Argentina and many, many other countries, and this held for Sweden in the late 1800s, banks, privately owned banks had the right to issue their own notes and coins. And so they did with limited success, because you ended up with many different exchange rates between these privately issued notes. So the lawmakers of that day, going to 100 years back, in their wisdom decided that there is going to be one institution issuing money the central bank, and that provides complete standardization of the system. That's how you create a unit of account that's generally accepted by everybody. Now, these ideas don't change just because you go electronic. The basic ideas and the basic trade-offs are exactly the same. It's just that we have never thought about it that way. So whether we will end up issuing electronic money to retail customers, to individual citizens, this will of course shock the banks, because that will mean that part of the business will be moved away from them to the central bank. That remains to be seen, and that is something that we will have to think very, very hard about going forward. I don't know the answer to that. My only reflection is that it happened in the late 1800s in many, many countries. Those trade-offs that people reflected on more than 100 years ago, they have not changed at all just because you tuck this stuff into a cell phone. Those trade-offs are exactly the same. Thanks.
Thank you, Fernando, Stefan.
Thank you very much to you all.